right, so E-mini S&P we won't cover tonight, but it's kind of similar to what this is shown here. But the E-mini NASDAQ 100 futures June contract delivery month 2022. This is a daily chart. And I felt that this morning we could have popped through, stabbed above these relative equal highs right in here, and then created this run lower. That's kind of like what I was prompting. Study that, because if it happens, you can see and study and backtest. Now that the market's already moved, you can go back in and look and see if the model in fact did what I teach. But here's the logic with that 1 hour chart and that relative equal high. So this is the framework. I'm looking for a run above here. If it can get above that, then what? It could wash out and go lower. Why would that be possible in terms of a pattern or a setup or the logic? What would be the catalyst for that? What was the reasoning for being interested in these relative equal highs? Number one, it's Thursday. It's Thursday and it's ahead of non-farm payroll Friday. Now, non-farm payroll Friday is usually a volatile day. It can be messy. It can be sloppy. Sometimes it's just really just a dud. It doesn't really do anything. Other days it could be extremely volatile, like the FOMC. But because FOMC has done what it's done, I don't think that the non-farm payroll numbers is going to have that much impact. But I was looking for these relative equal highs to be taken out, then drop lower, then create the model that I'm teaching. So that's why I was kind of drawing your attention to them, so that way if it did present that, you can have something to study. Now, what's the catalyst that sets the run up into those relative equal highs? I'm going to talk about that now. Much like I was suggesting in that post, we had dropped down into a discount. I posted ahead of the 9:30 opening, where equities open up, and that volatility that comes around 9:30, I want to see some kind of a manipulation in price. So if our focus, and I was trying to get your attention up here, if our focus is up there and it's dropping down and it's ahead of 9:30, what are we likely to see? Drop down, get traders thinking it's going to go lower, and then rally up. Not just go down indiscriminately and then go higher. It's got to do something specific. I'm interested in this area right here. That's what I posted in that community post, saying I'm watching this. And that was that little area right here. For all of these videos that I've been posting, it's very specific. I'm teaching fair value gap. That fair value gap is right there. Okay. So dropping down into that would be a point of interest for me, so that I can go in and look for something that gives me my setup. So in other words, this here is just where the trade might form. Hear what I just said? Where the trade might. It could. It may. Not it's absolutely going to. This is a promise. There's no way this can fail, because that logic doesn't exist in trading, except for over leverage and over trade. You're going to blow your account. That's a guarantee. Okay. But that fair value gap, that's the place in terms of price. Where should the pattern form? By itself, it's just price. But we have to incorporate what element first? Algorithmically, it's time. So I'm teaching you elements of time at that 9:30. We're expecting some volatility. Dropping down into that area here, which at this point of the chart, it doesn't do yet. So I'm looking for it to drop down into that area. If it does, then I'm going to be looking for what I teach you in this model. So with that area shaded right here, this is a 15-minute chart. You can see we traded down into it. The candle stopped right at the old candle high. And the next candle just gave up the ghost. Right away, we should notice that we did have the initial criteria, which is trading below an old low. So what's going to be resting below that? Sell stops. So they go down, run out the sell stops. Traders are caught in. Then what? What's the next logic? We got to look for displacement. It's got to trade back above this old low. It's got to have displacement above that. Did it happen here? No. Here is a 5-minute chart. Now, if you're looking at this with that same low here, it trades down below it. Did we get displacement above that old low? No. It just went down, consolidated, returned back to it, but melted. Didn't do anything above that old low. There was no displacement, no energetic move, so that way you can look for a fair value gap to trade back down into the buy. So anyone that would have looked at this and bought today is not using what I'm teaching. They're just impulsively pushing a button. And if they lost money, you have to fault yourself for that. All right, so now I'll talk a little bit about the model and give you a little bit more details and I probably feel like I beat you up and you're like, man, this is depressing. This is not what I was hoping to hear. I promise it was good stuff for you, okay? Now, I want to talk about where do these setups form. So in your journal, this is like a subtitle area for this video. Where do setups form? Okay, think about that for a minute. When you're looking for this idea that I'm sharing, the fair value gap, where would you expect them to appear in price? Obviously, I've been teaching you the run above an old high or relative equal highs. And if you're bearish, that would set up a scenario where the market goes up, sweeps the highs, breaks back down below the highs, short-term lows taken out with displacement, and then you go back through that displacement leg looking for a fair value gap to short into. That's pretty simple logic, isn't it? Well, visually, I want you to understand it. Okay, so that way, in your mind, I do this exercise all the time with my students. Can you draw out with a diagram, like if you were at work and you're trying to explain to your friend or coworker what it is you're looking for in price? Now, they're not going to understand what you're doing, but how would you draw it out in price or in a napkin with a pen or pencil? What would it look like? Well, you have obviously a level of relative equal highs, and we're just going to use that green line as an example of that. And price is moving towards it. Small little correction or so, and it runs towards it again. And then finally, it runs through those relative equal highs. Okay. At that moment, as soon as it goes above it, you start panning back through all this price run in here and find the nearest short-term low. Because that right there is going to be your trigger. It's not that it goes above this old relative equal high and then goes down below that. That's not it, folks. That's not it. You have to see it go below that and displacement with an energetic move, take out a short-term low. That's how you filter out these trades that may not be high probability. So that area right there, as soon as you run above the relative equal highs, in your mind, you're looking for where's the trigger. Because until it takes out that short-term low, there's nothing going on. There's no trade there. There's no setup there. Then when there's displacement, that displacement leg in price action, that right there is your foundation to the setup. That's it. Once you have that, then you can go into that area and look for the fair value gap. That's the logic. That's the pattern. That's what you're looking for. This is if it's bearish. Now, if those relative equal highs would have been traded through this morning, I would have expected this scenario. Okay. Before it ran those relative equal highs, I was looking for, like down here, price was trading down into that area. I was showing you my interest today. I'm watching this where it was likely to go down to, this is kind of like the low. In my mind, I'm kind of using it as an example. What I was expecting price to do once it got down into that fair value gap that I was saying. I'm watching this, that little arrow. Okay, I showed that little gap. I was expecting this type of movement to set up the run above those relative equal highs. But there was no movement here to set up that run either. So two scenarios that I would have loved to seen develop just did not pan out. It just simply wasn't there. Now, I'm going to teach you another approach, and this is kind of like what I was expecting. And had it panned out this morning, if it would have gave the real setup, which it did not, I've already shown that, that little fair value gap that I was waiting to see a response in, it didn't do it. Just melted right through it. But if it would have done this, but this is going to be a sell version, okay? Just reverse it for the going long idea. If you have an old fair value gap above you, okay, so you have an old fair value gap, and the market's below it, and it's trading up, and you're bearish, but you think it's going to go up to that fair value gap. The same logic when it trades up to the relative equal highs. Once it trades into that fair value gap, it doesn't have to completely close it. If it trades up into it, anywhere between here and here is good. Okay. If it trades above it, you can really make it simple and say, okay, the low of the fair value gap, treat that like the same logic that you use for the relative equal highs. Doesn't that make it simple and easy? That way you don't have to worry about how hard do I need to know? You don't need to know that because you're waiting for something to happen. What is that? Once it takes out the low of the fair value gap and trades in there, you go back through that leg and see, okay, here's what? There's that trigger. That's that shift in the market structure you're waiting for. Then you have the displacement leg. So once you have that, you can go back in and look for the fair value gap. Okay, so that's the two entry strategies for this model.